Hello, everyone. Today, I will deliver a topic about assessment of the efficiency of corporate business activities. I'm Guanming from the Durham University in United Kingdom. Well, firms always aim to make profits and grow the profits for the long term. And to this end, the company needs to do well in advancing its strategies in both the product markets and financial market. And these strategies involve operational management, investment management, stipulation of financing policy, as well as dividend policy in a good and reasonable way. And in this speech, I will deliver how to assess the efficiency of the company's operational management, investment management, financing, and dividends payout. Regarding the operational management, it's crucial for the companies to manage its costs in an efficient manner. And there are two basic types of the costs. First is production cost, and the other one is period cost. And let's first take a look at the production cost. How to estimate the optimal level of production cost that should be maintained by the firm for its operations. And the production cost is closely tied to the ending inventories. And we have a basic equation, which is the ending balance of inventories is equal to beginning balance of inventories plus production costs and minus the cost of goods sold. So in order to figure out the optimal level of the production cost, we need to first know the optimal level of inventories. And this optimal inventories level should be tailored to the market demands for the firm's products. The inventories should not be at a too high a level or too low a level. If the level of the inventories is too high, then the company may face the risk that part of the inventories might become obsolete and out of date. This will result in impairment losses on the inventories. And furthermore, the inventory holding costs will increase. And this will eventually lead to the reduced gross profit margin. Yet, the company cannot maintain too low level of inventories. This is because in case the consumer's demand for the products, the company needs to have the goods in stocks for selling to the consumers who needs them. And if the company's inventories are at a too low a level, the company will face the lost sales. So it's crucial for the companies to maintain a reasonable level of inventories. And we can rely on a regression analysis to help ourselves to figure out what level of inventories that should be optimal for the firm. To this end, we need to first figure out the fundamental determinants of the production cost. And by definition, the production cost could be divided into cost of goods sold and the change in the inventories. And this change in the inventories is the cost of goods that are not yet sold for this period. We have a separate determinants of the cost of goods sold versus cost of unsold goods. Let's first take a look at the determinants of the cost of goods sold. They are innately determined by the current year sales. In other words, if the sales for the current years are higher, then holding all else constant, the cost of goods sold should be higher, right? On the other hand, the cost of unsold goods should be determined by the sales growth in the current years as well as in the previous years. Why? This is because the cost of unsold goods, the cost of unsold goods is manifested in the increase in the inventories. Since the goods that has not yet been sold out will be left in the inventories. And if the market demand for the products keep growing, in other words, the sales growth is high, then the company should increase the inventories to meet up with the growing market demand for the products. So the cost of unsold goods should be high. Okay. So take together, we have three basic determinants of the production cost: sales in the current years, change in the sales in the current year, and change in the sales in the previous year. We estimate this regression to get the fitted value of the production cost. And this is used as the measure of the optimal level of production cost to be maintained by the firm. And then we can use this equation to calculate the optimal level of the ending inventories for the firm, which is equal to the beginning inventories plus our estimated optimal level of production cost minus the cost of goods sold incurred by the firm for this year. Okay. How about period costs? Unlike production costs, the period costs are not directly tied to the production process, so they are recognized as an expense in the accounting period in which they occur. Example period costs include sales, general, and administrative expenditures, advertisement expense, and research and development expense. The optimal level of period costs could also be estimated by a regression analysis. First, we identify the innate determinant of the period cost, which we give another name, discretionary expense, which means this period cost is at the discretion of managers. Okay. And this period cost should be determined fundamentally by the previous year sales. If the previous year sales are higher, then the current period cost should be higher. The period cost to be incurred for this year need to be budgeted based on the previous year sales. So we will expect the coefficient on this variable to be positive and statistically significant. We estimate this regression to get the fitted value of the period cost and use it as a measure of the optimal level of period cost to be incurred by the firm. So for each firm, we have better estimate the optimal level of the period cost and production cost such that the companies can do effective cost control for the company's operations. Then we may proceed with estimating the overall operational efficiency of the firm. And basically, it's gauged by the comparison between the outputs with the inputs associated with the production of the firms. We have 6 basic inputs into the production process. And these inputs could be divided into the short-term costs versus long-term costs. For the short-term costs, we have cost of goods sold, selling, general, and administrative costs, research and development costs. For the long-term costs, we take account of property, plant, and equipment capitalized by the firm, as well as the capitalized operating leases and the acquired goodwill and other intangible assets. These 6 types of the costs are crucial for the company's production, so we need to account for all of them when we calculate the amount of the inputs into the production process. Regarding the output, we use the sales revenues as the measure. And we divide the sales revenues by the sum of all these costs to get the measure of the overall operational efficiency of the firm. If the ratio is higher, that means the companies will have high operational efficiency. The operational efficiency could also be supplementarily measured by the firm's cash conversion cycle, which is also known net operating cycle. It is equal to the company's whole operating cycle minus the days payable. And the operating cycle is equal to the days inventories outstanding plus the days sales outstanding. Let's look at this figure. The cash conversion cycle corresponds to the period from the point when the companies pay the suppliers for the raw materials to the point when the companies manage to collect the cash from the consumers. And it is equal to the whole operating cycle, which is the sum of these two items, minus the days payable. If the period is short, that means the companies will have a high financial health and good liquidity position. In addition to the fact that the company's overall operational efficiency is high. Okay. And we also use this cash conversion cycle as a measure of the company's financial health and liquidity position, in addition to the company's operational efficiency in terms of the speed of the generation of the output relative to the inputs of the production. Now let's move on to talking about the investment efficiency of the firm. How we define the efficiency of the company's investment. You know, the company investment need to be made based on the market demand for the products. In other words, the products and services produced as a result of the investment should meet up with the needs, preferences, and tastes of the consumers. Okay. If the investment will bring higher sales to the firm, that means the companies will have a high investment efficiency. Likewise, we can use the regression to estimate the optimal level of the investment and thereby to estimate the efficiency of the investment. And here, the investment could be measured in two ways. First is to use the capital expenditures available in the statement of cash flows. The second way is to calculate the increase in the net long-term assets. And these long-term assets could be attained from the firm's balance sheet. Okay. We can use these two different measures of investments as the dependent variable in the regression. And on the right-hand side of the regression, we control for the innate determinants of the investment. As I mentioned just now, the company's products need to meet up with the market demand. If the market demand for the company's products keep growing, then the companies will have more investment opportunities. So the company's investment level should be fundamentally determined by the company's growth prospect, which represent the market demand for the company's products. If this growth is higher, then investment levels should be high. And we can measure the growth by either the sales growth of the firm or the market to book ratio. The second variable reflects the stock market expectation of the company's growth prospect. And the coefficient of this growth is expected to be positive and statistically significant. The rationale underlying the model specification is that the corporate investment should be tailored with the expected growth in the market demand for the firm's products and or services. The underlying assumption for this model is that the optimal level of the investment should be innately determined by the growing market demand for the company's products or services. And any deviation from the optimal level is attributed to the company's either overinvestment or underinvestment in the product or service market. And if the residue we estimate from this regression is positive, that means the companies might overinvest in the product market. Conversely, if we find that this residue is negative and significant, then the companies is likely to underinvest in the product market. So put in another way, if the residue is of smaller value, then holding all else constant, the company will have a high investment efficiency. And this model is proposed by Biddle et al. 2009, and this paper is published at the Journal of Accounting and Economics. And this model is subsequently used by a range of empirical studies on the investment efficiency. However, there's a limitation with the previous model because the growth is not the only determinant of the company's investment. There are other factors that might also affect the company's investment substantially. These factors include the financial leverage, cash, firm size, stock returns, firm age, and the previous year's investment. If the companies have a high level of the financial leverage, then it's not good for the firm to make big investment because this additional big investment will increase the company's financial risk. Okay. And also, the creditors will have incentives to restrain the companies from making further investment if the leverage level is too high. If the company have a large amount of cash, then it will be good for the firm to make use of the cash to make more high return investment in the projects. If the stock returns is high, that means the investor will expect higher return from the investment. So in this case, the company had better make more investment in the product market. So we expect that the stock returns will be positively associated with the investment level of the firm. If the firm have a long listing history, then they should be experienced in making use of the external funds for the investment. So they are likely to make better investment. So in this case, we will expect that the firm age will be positively related to the investment level of the firm. You know, investment need to be ongoing in multiple years. So the investment level is likely to be autocorrelated across different years. So we need to also control for the previous year's investment level. So collectively, we take into account all the possible major determinants of the investment and estimate the fitted value of the investment level and use this fitted value of the investment level as the optimal level of investment that should be made by the firm. And any deviation from this optimal level will be attributed to either the overinvestment or the underinvestment by the firm. And we can use the residue to measure to what extent the companies overinvest or underinvest in the product or service market. And we see the magnitude of this residue. If it is too positive, that means the companies overinvest to a substantial degree. So too is for the case of underinvestment. Okay, it could be measured by to what extent the residue of this regression is negative. Last, how about further controlling for industry growth in the market? It's important in some sense to control for the overall market demand for the products for the whole industry. Okay, let's assume that the aggregate market demand for the industry products is very high. Then the company may face less intense competition on the investment projects, and the investment they make are likely to yield higher sales and profits, okay, because the pie of the cake is big enough to be shared by different companies. Okay, so in this case, the investment efficiency is likely to be high. Okay, and this will in turn incentivize the company to make more investment. You may refer to one of my paper published in the Economic Letters in 2022. In that paper, we further control for industry sales growth in this model that is used to estimate the investment efficiency. Now let's move on to talking about the company's financing policy. You know, there are two basic ways of raising funds from the market. One is debt financing, the other one is equity financing. And when the company's internal funds does not meet up with the investment or operational needs, they need to seek external funds from these two markets, either the equity market or debt market. And you know, the debt holders and equity holders have different expectation on the returns and risks associated with the provision of the capital. For the debt holders, they will demand lower risk from their provision of the capital to the firm. So as a result, the debt financing is cheaper than the equity financing. Okay. The interest on debt are tax deductible, but the dividends paid to the shareholders are not. And creditors might discipline the firm managers from taking excessive risk in the investment and operation and from making wasteful expenditures. And furthermore, the managers only need to convey the proprietary information to the private lenders without releasing this information to the public. Okay, but if the company want to raise the money well from the stock market, they need to release fully and also on a timely basis all the information to the investor. Okay, to make the information asymmetric between the firms and investor to be low, and as a result, the cost of financing will be lower. But on the other hand, the companies might incur proprietary costs of the disclosure. Okay, that means some information might be valuable to the company's competitors in the same industry. Okay, so the selective disclosure of the firm's strategies and future prospects will be good to the firm in some sense. Okay, so if the companies care about keeping the proprietary information, not letting the competitor knows about this information, then it will be better for the firm to raise the money from the debt market, okay, to borrow money from the private lenders, which only require the release of the information via the private channel rather than the public domain. There are also costs of the debt financing relative to equity financing. If the companies raise excessive debt, then the companies will face high distress risk in case the firm defaults on the payment of the interest and principal. And more importantly, the debt holders have the right to impose covenants on the firm, restricting the company's operational investment and further financing decisions, and that will not be good for the firm. So there's a benefits versus cost of debt financing relative to equity financing, and this depends on the different expectation of the debt holders versus shareholders on the risk and return associated with the provision of the capital to the firm. So take that in mind. We need to take account of the capital structure when estimating the company's financing efficiency. So in other words, how can a firm achieve a higher financing efficiency while maintaining an optimal capital structure? And this is an important issue that the company need to solve when stipulate the financing policy. Financing is very important for the company's operation and investment. So it's always good for the companies to figure out in what portion of the funds that should be raised from the debt markets versus equity markets. So we can run a regression to estimate the optimal level of the financial leverage. And to this end, we need to figure out the fundamental determinants of the debt to equity ratio, that is the company's capital structure. Here, there are several innate determinants of the financial leverage. First is the growth prospect of the firm, measured by marketable ratio. Second is the asset tangibility, measured by the ratio of tangible assets to the total assets of the firm. Third is the firm size, measured by either the lecture law of total assets or equity. Fourth is financial flexibility, measured by the ratio of the cash to the current liabilities. Fifth is the firm risk, which could be measured either by the cash flow volatility or earnings volatility. The last one is the profitability, which could be measured by the return on equity. So if a firm have a high growth, then equity financing is preferred over debt financing. If the company have a large amount of tangible assets, which can be mortgaged or liquidated for the debt repayment, then debt financing is preferred over equity financing. Larger firms are more capable to fulfill that obligation. So too are those firms that have high financial flexibility. So in these two cases, the company may consider raising more debt from the creditors. But the debt holders do not like bearing higher risk. So if a firm is of high risk, then the firm may be better to raise the funds from the equity market rather than the debt market. And lastly, if the firm is of high profitability, then they may consider raising the level of the financial leverage because they are in a stronger position to repay the debt and the interest. We estimate this regression to get the 50 value of the debt to equity ratio. And this 50 value of the debt to equity ratio is a proxy for the optimal capital structure of the firm. And then we can use the residue as a measure of the financing efficiency. If the residue is of higher value, that means the financing is not efficient. Okay. Conversely, if the residue is of a smaller amount, then the financing efficiency is high. So this residue of the regression is the inverse measure of the company's financing efficiency. Thus, what is the optimal dividend payout for the firm? The company's dividend policy is value relevant to the firm. Why? This is because shareholders not only care about the capital gain from their investment, but they also care about how much dividends the companies will pay back to them for their investment in the stocks of the firm. Okay. If the companies can stipulate a good dividend payout policy for the shareholders, then the firm will find it easier to raise the funds from the stock market. So this will result in a lower cost of capital. Okay. And also the company can get the money on a timely basis from the stock market to make the important investment and to maintain its operational management in a good way. So to estimate the optimal level of the dividend payout, we can use this regression, which we identify all the major determinants of the company's dividend payout. Okay, and designated determinants of dividend payouts include the growth, financial health, firm size, profitability, share price, and the risk of the firm. If the among all these factors, the first two factors are of paramount importance for the company's dividend payout policy. If the firm have high growth, then the firm had better not pay too much dividends to the shareholders because they need to retain this money, retain these earnings, plow back the profits for reinvestment to achieve sustainable development goals. On the other hand, if the company have an excessive amount of cash, then the firm had better pay the dividends back to the shareholders to please the shareholders. And in the meantime, the firm can avoid the agency problem associated with the excessive free cash flow because the cash flow are the easily investable assets in the firm. Okay, the managers can easily embezzle the cash and the associated resources from the firm. So it's always better for the firm not to maintain too high level of the cash within the firm. And other determinants include the firm size, profitability, share price, and risk. And here I would like to mention, if the share price of the firm is high, then it's likely that the shareholders will expect more dividend payout as a payoff for their investment. And if the company is very risky, then the shareholders will also demand more dividends to compensate for the risk they bear for the investment. So in sum, we need to account for all these possible major determinants of the dividend payout and estimate the optimal level of the dividends that should be paid to the shareholders. Okay. So in sum of my speech today, we have talked about the efficiency of the company's operational management, the efficiency of the company's investment, as well as the optimal financing policy and dividend payout policy for the firm. And the company needs to maintain a high efficiency in its operation, investment, financing, and dividend payout in order to make sustainably higher profits in the long term. And in my delivery,